Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about how the S&P 500 can get to 4,200 or lower. Today we're going to talk about downside objectives. You know, when you have a market in a consistent uptrend like the S&P or the NASDAQ through much of 2023, you don't have to think much about downside objectives. That's really only something you need to kick into gear when things start to rotate lower. Arguably, now we've seen that. The S&P 500, the NASDAQ 100, both breaking below their 50-day moving averages, now really threatening to go a much lower. And so the question is, where do we go from here? Today we're going to talk about some measuring techniques, two particular approaches. One, treating the S&P 500 like a head and shoulders topping pattern, which is certainly possible. The other one, doing what it's called an ABC correction, basically a three-wave pattern, assuming that we are done with wave A, that first inertial move down, and that wave B, now complete after NVIDIA's earnings, strong earnings, but price disappointed. A lot of growth stocks giving some real distribution signs going into Friday. If we see further downside, this is how those levels could be engaged. Before we get to that chart, by the way, if you like this sort of thinking about technical analysis, market dynamics, and investor psychology, why not subscribe to the channel? Also, give the video a like if you appreciate it. It would super help us out, and we would very much appreciate it back. Drop a comment below. What is your downside objective for the S&P 500 and why? Now here we're looking at a pretty clean chart, and as I mentioned, right, we had the uptrend in the S&P really from the October lows to where we're at now. Now we're in sort of a pullback phase. I think that's fair to say at this point because we've dropped, a decent amount off the highs. Some stocks have dropped quite a bit, of course. Some of the leadership names like Apple and Microsoft and others. And to be honest with you, in a bullish market trend, in a long-term uptrend, it is actually very normal to have consistent pullbacks like this, or not frequent but occasional pullbacks, usually 2 to 3 a year, in sort of this 5 to 10% range. It would be unusual to not have that happen, as opposed to unusual that it is happening. So pretty reasonable that the market could actually be still in a long-term bullish structure, and that this is just a pullback phase or a corrective phase within that longer-term uptrend. It's kind of our general base case for the S&P for the third quarter into the fourth quarter of this year. But let's get to the chart of the S&P and talk particularly about two ways to measure potential downside objectives. And again, you really only need to kick these in once you feel the market's rotated lower. Now that stocks have started to break down through support, now that the breadth indicators have gone from euphoric to much less optimistic, and now that the S&P and the NASDAQ are breaking key levels, now's when you need to start thinking about it. So the first option is we treat this like a head and shoulders pattern. This right now, it's happening, is sort of the beginning of a right shoulder, or maybe a complex right shoulder, we'll have to see, and a breakdown would complete that pattern. So number one to remember with this sort of thing is you really have to be patient with patterns like this. And what I mean by being patient is you have to define the neckline. The neckline is basically first identify the head, the left shoulder, and the right shoulder. And for now, we're assuming this is kind of the beginning of a right shoulder kind of pattern. You can see you have kind of two little left shoulders here. So maybe we have a similar sort of echo over here, and we have two little right shoulders. But at some point, we continue to distribute. The price of the S&P, or the value of the S&P, is going to go below 43.50, complete a rotation below this neckline. And what you have to remember is until that happens, at this moment, it is not a head and shoulders pattern. At best, it is a potential head and shoulders pattern, because these patterns are not completed until you complete what's called the trigger, as I would call it, right? There's the setup, there's the trigger, and then there's the follow through or the confirmation. So if and when we would break down through this neckline, then you can engage the downside measurement technique. Here's how it works. We're going to take a percent change tool, basically take the measurement from the high there, which is the high from late July. We take it down about to this trend line. It's right about 6%, not too far from there. So what you technically need to do is wait for the breakdown. Let's say it takes another week or so to kind of do that. Right around here, the beginning of September, we actually break through that level. You basically take the height of this pattern right here. I'm going to get there all the way. There we go. You take the height of this pattern, of the head and shoulders pattern, and once we complete the breakdown, so if and only if we break the neckline, then that says now that this is the topping pattern, there's my downside objective. You can see it goes right down to 40.75, we'll call it, just below 4100. What's interesting about that particular range, by the way, is it lines up really well with this kind of area back here. This is the support levels from April and May. This is after the February, March drop. We retested the February high around 4,200. If you remember, we consolidated here for a couple months before finally breaking out at the end of May, and that really continued the market 2 straight months of upswings in June, making the eventual high for now in July. So a 6-point move or 6% move, if we do break through that neckline, would take us down to 40.75, 4,100, which would basically take us down to retest those April-May lows right around that area. Now, let's assume what I just said is not happening, and instead of that, we do a different measuring technique. Instead of thinking of it as a head and shoulders pattern, another way you could actually consider this would be to think of it as what's called an ABC correction. There are different names for this, to be honest with you. I've heard this called like a drop-based drop and different things. I'm not super keyed in on all the precise names, but it's basically a 3-wave pattern. You have the initial move where investors are kind of in a disbelief. You have that next bounce, and then another move lower. Let's assume that this was wave A, that first wave down off of the high around 4,600. Let's assume that's the first wave lower. Then we have this shallower bounce, about a week or two, going back up here to around 44.60, we'll call it. Let's assume this is the beginning of the rotation lower for the wave C, right? So what we need to do is actually take this, take that arrow, copy it, and let's assume we top out right around here, right around that same level, and we have the next wave down. You can see this gets us to a downside objective around 41.75 to 4,200. That would get us down to this area, which is right at the February high. We talked about how the low after that pullback in April and May, that would be that first objective. This is a little shallower objective, but I think equally valid, which would be this is a 3-wave corrective pattern. It would take, depending on how long this wave B takes, it could take longer, push this price out a little bit, but let's assume this happens sort of in September and October. If you think about the way that I've drawn these lines, it implies a major low for the S&P and the NASDAQ sort of in that late September timeframe. And I have to tell you, when you look at market history and you look at seasonal tendencies, the number of times where we've had a major market bottom right around this time of year is super prevalent. It happens a lot. So the fact that we would have this sort of 3-wave correction or a head and shoulders topping pattern giving us a downside objective sort of in this area, not only would it make it an incredibly common and incredibly reasonable pullback within a bullish phase, it also would line up very well with the timing of the particular trends that we've seen here so far in 2023. Also remember that if and when we would get to those downside objectives, I would argue that probably sets up a really good fourth quarter. And in the fourth quarter, particularly in pre-election years, tends to be pretty strong. And that could be the strength that we need to go into the sort of holiday season when the markets usually are pretty strong going into year end. So what's really interesting about these two measurement techniques, the head and shoulders top or the sort of ABC corrective pattern, look at how that lines up with some other methodologies. Here's one of my main S&P charts that I use all the time. I have some Fibonacci retracements, some support levels, and some trend lines drawn. And just think about those levels we just talked about. That level we just talked about was around 41, where do we come up with? 41.75 to 4,200, we'll call it. Look at my daily chart of the S&P. You'll see there's already a purple shaded area right there. Now, why do I have that area highlighted? Number one, this was the February peak, right, around 4,200. This was also an important breakout level here in April and May. Of course, we stalled out in a retest of the February highs and eventually broke out. So a level of resistance that is that confirmed when we come back down, I'm going to naturally assume there may be some support there. That also represents a 38.2% retracement of the way back down from the July 2023 high and the October 2022 low. It actually lines up right around that same level, around 4180. I'm not done. If you draw a trend line from the October 22 low and the March 23 low, the two major lows over the last 12 months, and you track that trend forward, that gives us an objective of right around 4,200, depending on how quickly prices would come down. So here we have what's called a confluence of support. And I didn't even mention the 200-day moving average, which is getting nearer and nearer that range as well. So a bunch of different approaches all are kind of coalescing around that same level, right around 4,175 to 4,200. And a measurement technique using that ABC pattern gives us the exact same downside objective. That's where I think that may be a really ideal bottom point for this pullback phase. Now, if we get a little bit further, that would get us down to this other blue shaded area, which would be around 4,050 to 4,100. That would represent a 50% retracement. Basically, we're tasting half of the rally from October of last year to July of this year. About half the way down would be right around 4,050. So that 4,050 to 4,100 level has served as resistance and support many times. Look at how many times the price is in this area, reverses around there, finds support, finds resistance. So pretty reasonable that you would expect further support if the price gets there. So I think as a downside objective, I don't see the market getting much lower than that level, and that would be the measurement technique. If we do that first measurement of the head and shoulders top, that will give us an objective right around that blue shaded area, sort of 4,050 to 4,100. So those are two measurement techniques that give us a downside objective around 4,200, around 4,100, based not just on the patterns we talked about, the ABC corrective pattern or the drop-based drop pattern, also just a head and shoulders pattern, assuming that a right shoulder forms and is validated or confirmed with a break below the neckline. In either of those cases, there are other technical tools that really support and validate, confirm those levels as important potential levels of support for the S&P. I would say, given the weakness that we've seen in growth, given the growth stocks, given the higher rate environment, would not be unreasonable for the market to go down to those levels and maybe set us up for a strong fourth quarter. And you have to believe that the average bull market phase has a lot of common pullbacks, just like the one we're seeing here in August and September of 2023. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. We'll talk to you again soon.